My name is Shraddha Ghosh, and I'm going to be your instructor for today's session. We're going to start with leases, and frankly speaking, it's one of the most dreaded topic in entire FAR. Okay, so what we're going to do is we're going to break it down into smaller sessions. We're going to talk about the concepts first, and then we're going to solve two sums end to end from the entire comprehensive situation where you can understand the entire flow of transaction between the two parties involved. Once you're able to do that, we'll be able to crack leases completely. Okay. If you guys have, one request. Anita, please change your name. No, it becomes very difficult if I just see Zoom user or 123 written there. Just change your name. Okay. Okay, a couple of tips before we start our session. If you have a query, please write in the chat panel. In case if I feel that we can unmute you immediately, I'll unmute you and we'll take the question. Otherwise, we'll just wait for the question to be answered once we're through with a particular session. I am, for the last time, sending an Excel sheet and I'm sharing it with you guys. Anybody who has not downloaded this Excel sheet, can you please download it and keep it ready for today's session? Okay. Okay, so what we're doing today. So what are we doing today? Now, see, leases is one standard which underwent a huge change a couple of years back. And why was that change introduced? I'll let you know that also. But first, first we'll do a couple of questions before we can crack and understand why there was a need for making those changes in leases. Okay, so what we're going to do today, we're going to cover the entire gamut of concepts surrounding the lease. We first talk about what is a lease, why are we talking about it, and why is it so important. So what is the fundamentals behind a leasing transaction? Now, after that, we're going to talk about some typical terms that we're going to use in leases. One second. Sharon, do you have a question? Can you just write in the chat panel? I see your hand is raised. Were you able to download the Excel sheet?
No, that is. I wanted to ask. I did not see that on portal under leases.
No, it's not on the portal. It's in the chat panel.
Oh, okay. I'll just see it.
Yeah.
Thank you.
Yeah. One second. Yeah. So here again, before we are going to proceed, we're going to talk about the classification. Why is classification important? Because unless and until we know how do you classify the lease, it is going to be difficult to account for it. Okay. Then we're going to talk about the accounting, which is the most important part. There are three kinds we're going to know about it when we proceed further. We're going to talk about three various kinds of leases. But you'll be surprised to know that the one which was, one second, Anita. Anybody else having issues in locating the Excel file? It is there. I have just shared it in the chat panel. Click on it, download it. The file goes with the name leases question. Okay, if there's still somebody who's not clear or who's not got the file, please let me know. Without that, you'll not be able to follow today's session, guys. Okay. So there are three different kinds, and you'll be surprised to know that the one which people really find very daunting is a very rarely used one. Okay. We're going to talk about something called sale leaseback transactions. And the most interesting part, we're going to review Tesla's financial statement, because you'll be surprised to know whatever we have studied or we would be studying over the next 1.5 hours would all be shown in Tesla's financial statement. So Tesla is one company which has an enormous use of leasing. I don't know if you're aware, but in India, you can lease Tesla cars, but in the US, where the economy supports a lot of leasing. I know a lot of Indians in the US who do not own or buy a car, they just get into leasing transactions. Tesla came up with the concept that I'm not going to give you the cars on lease if you are residing in the US. So as a policy, Tesla was a looked upon model in the US, and none of the people who in the US wanted to lease Tesla's car were, guys, just 1 second, there's somebody here. Okay. So that leasing option is not available in the US, but in Asia and in Europe, Tesla allowed the leasing of their vehicles. So we're going to talk about how all the two kinds of leases. See, the third kind which got introduced in the which generally people think about a lot, is very rarely used in leasing. So in fact, even in your CPA syllabus, you will be seeing that we are just going to touch upon the concept of direct lease, direct finance type lease, but we're not going to talk about it in great detail because the working for this is really cumbersome and outside the scope of CPA syllabus. If you are able to crack the first two kinds really well, which means the operating and the sale type lease, we have finished a job. This typically works like a theoretical construct for you. Okay, we will be solving a question, but you have to understand that question is a very toned down question. I'll give you an idea of what these kind of questions generally aim at in real life scenarios, but that is again for your understanding. We are going to talk about sale leaseback, and it's a very interesting concept. Again, we are not going to do this in a lot of details because that's beyond the scope of your exam. But those of you who are with us, once you're able to catch up with the concepts that would be taught today, if you guys are really interested, we are going to take a more detailed question on this at some later stage, but not today. We are going to talk about the concepts and going to talk about stuff which will generally be tested at your level. But for the sims, typically for the sims, I am not looking for a very detailed sale leaseback transaction as far as a full blown up sim is concerned. In my opinion, the operating and sale type leases are more likely to be tested in a very complicated scenario. So these two is a main deliverable that we have in today's session. Okay. And of course, this is a very interesting thing. We are going to look at it, and you'll be surprised to know how much you'll be able to make out once we are through with today's session. Okay. Anybody, any questions before we start? Any questions? Okay. Now, see, the moment we talk about lease, it is typically a contractual agreement. There are two parties involved. One who is the owner of the asset. We're going to typically refer to them as lessors. So these are the people who own the asset. So in my example, if I talk about Tesla, Tesla manufactures the cars, which are very sophisticated, comes up with a lot of features, has the added advantage of taking care of the environment. And that's the reason a lot of people have a lot of efficiencies, and it is a environment friendly car. So if Tesla chooses to lease the car with an option that, and you will be seeing that, when we read Tesla's balance sheet, you will see that Tesla typically lets these cars out on lease with a pre-term, saying that, so this is a typical arrangement that Tesla has with its Asian and European customers. It says that, see, I have a car, so this is Tesla, and this becomes a lessor because this is a company that manufactures those cars. And let's say you and me, let's say we have now how many people today? Okay, let's say we have Anirban here. And let's say Anirban wants to buy a Tesla car because it's really excited about it. And Anirban goes and takes that Tesla car. So the moment that Tesla car is given to Anirban, there is a detailed agreement that will be signed, which typically in Tesla's case, you will see is a 72 months contract. Okay, so it's like a 6 years contract. And there would, so let's say we'll just take a value. I have no idea if you guys have any idea how much is the landed price of Tesla in India. I am totally clueless. But anybody, any idea? What is the landed price of Tesla in India at the moment? Just give me a ballpark figure. Even if that is there, it will make it more reasonable. Otherwise, I'll have to just take a dummy figure and go ahead. Any idea? No? Okay.
No idea,
So
really.
sorry? 50, my goodness, awesome. So let's say it's a 50 lakhs, right? So ideally, if it's a leasing transaction, the terms would state something like this, that over a period of next 6 years, every month or every fixed period, typically it's a month, and everyone would have to pay X number of, some installment. We call it monthly installments. And at the end of 72 months, there would be a price that we set. And that price, Anirban will have to refund to Tesla. In other words, a car will go back at a predetermined price to Tesla. Okay, so this is a general situation. I know what is going to be the resale price. Why? Because the resale price will determine what is the monthly installment that any customer, in my example, Anirban is supposed to pay to Tesla. So what do we have? We have two parties. We have one party who owns a car, and we have another party who's going to lease that car. So technically, Anirban is now using that car, and the car does not belong to him technically. The car belongs to Tesla, and Tesla is going to take back the car from Anirban after 6 years. But guys, you will have to now tell me, what do you think is going to happen? Will Anirban actually own the car and write the car in his books? Will Tesla own the car and write the car in his books? Who's going to depreciate the car? Because technically the car is never going to belong to Anirban. He's going to give back the car to Tesla. Do you understand what are the problems that might come in? Because it is a car, the owner will still remain to be Tesla. But then again, a car, what can be the expected lifespan of a car? 6 years, and the 6 most prime years if the company is giving out the car to a user. Then what do you think would be the maximum value of the car, right? So the question involves who is going to bring the car in whose books? Who's going to depreciate the car? What will be the amount of depreciation? If I bring the car, so let's say if Tesla actually sells this car, what will be the value of sales? We don't know, right? If Anirban brings the car, first of all, why will he bring the car? And second, if he even brings it, at what value will the car be brought in his car? All of these questions will be addressed in a scientific manner when we talk about the lease standard, right? So we have two parties. There is a detailed agreement that lists down who is going to bring the car in whose book at what value and how are you going to deal with it. Okay. Apart from that, so what happens if you typically see in any lease contract, there is a party who owns the asset and he gives you the right to direct the use of that asset. That right is the right to use the asset. Now, general rule, you're going to talk about two things here. The first thing is that it should not be a substantive substitution right. What do you mean by that? Let's say after using the car for 3 months, if anyone comes up and say there's something wrong with the car, I'm not happy with the model, the performance, it's not what you have promised me to be. And Tesla says, okay, give me the car, I'll give you a fresh new car. That means I don't have a specific model that I'm talking about. That is an interchangeable property. Now, we generally, whenever we talk about leasing, guys, we don't talk about interchangeable commodities which can be easily substituted. That's not what we're talking about. We're typically referring about a typical model, a specific asset. So in my example, if anyone reports with a problem, at the max, Tesla will fix that problem. The industry standard should be that the problem should be fixed. The warranty of the performance will be there. If the parts are defective, they will be fixed. But the idea that Tesla will take away the car and will replace it with a new car, that is typically not what we are looking at if it has to be a valid lease agreement. In other words, the assets for which this standard are going to is going to be applicable is an asset which is a heavy and a big asset where the owner, in order to honor his part of the commitment, would probably fix the asset if there is a problem rather than replacing the asset totally. So those are not high quantity, low value assets. These are low value, these are low quantity, high value assets where we're talking about one specific asset. So if that Tesla car is given to Anirban, there must be a specific chassis number which is his car. And we can fix the car, but we will not replace the car in most ideal situations. Can Tesla come up and say that there might be some protective rights? The answer is yes. Protective rights are okay. What do you mean by protective rights? In order to honor that lease, Tesla might come up and say, okay, Anirban has to take the car for servicing every 6 months. When the car comes for servicing, the tire rotation, the fuel, and all of this has to be changed every X number of days. Now, those and the car cannot, meet with an accident more than this number of times. So all of those are okay because it is the owner's asset which is going to go back to the owner. So we can have protective rights, but we cannot think of substantive substitution rights for the asset that we're talking about under lease. Okay. So typically what we do, I am the owner. Tesla will give the right to use the car, which might come with certain apprehensions. It might be a simple so we'll go talk about what these leases are. If you classify the lease, how would you be able to classify the leases, right? So one party gives the other party the right to use his asset. That right cannot be for a asset which can be easily replaced. It has to be for a specific identifiable asset. Typically think about high value, low quantity items, specific items. And in lieu of it, Anirban will have to pay a fixed dollar or the rupee amount to Tesla at every periodic interval, right? So all of this is stated very nicely in the contract, which is arrived at between the two parties, which is the lessor and the lessee. Now, one thing is very clear. Since we've already covered topics like intangible assets and inventory. Generally, when we talk about leases here, we're talking about a particular heavy asset. Lease as a topic is not very commonly used for an intangible asset or something which is low value, high quantity item. So what are the typical terms? Now, these terms might not make a lot of sense right now, but we are going to use these terms when we are going to solve questions. So we need to understand what these terms are. One is the period of the lease, right? So in my example, when I said it is a 72 months period, that is the period for which the lease is going to be applicable. Now, think of a situation, in Bay Area in California, where when you have the asset and when you give it for the people to rent out, those condos or houses where you're staying. Now, generally in US, what works is they'll tell you, okay, the lease has to be for, let's say, 36 months, 24 months. And they will also come up and say that, okay, out of these 24 months, you have to pay me the last 3 months rent in advance right now. In order to promote the leasing, they might come up and say that for 6 months rent, I will make you free of cost, right? So there may be various terms, but what is important is that when we say what is the tenure of the lease, when we say lease term, we're typically talking about the tenure of the lease. We're talking about a period which is non-cancelable, and that is a period over which the lessor is going to give the lessee the right to use the asset. So let's say if I tell you that the asset is for initial 3 years, but the contract says, so there's somebody who's a builder in the Bay Area and he holds a huge property, and there's one condo that he gives, let's say Anita. So he comes and says, Anita goes to stay in Bay Area. She wants a flat on rent. She goes and approaches a builder. He gives her that condo on rent. And the terms of the contract stated that the condo is given for the first 3 years at so and so rate, and Anita has the option to extend it for the next 2 years at a price which is X percentage higher than the earlier price. Now the question is, when I talk about the lease term, will I think about 3 years? Will I think about 2 years? Will I think about 3 years initially? And then later on 5 years? What do I think? The answer is, if Anita is reasonably certain to exercise that option, I'm going to treat it as if it's a 5 years lease right away. On the contrary, if the lease, let's say for a factory building lease is given to you for 15 years, and there is a penalty if you foreclose the lease early. And even when you are signing the lease, you know that you're going to foreclose it 5 years early. Then you're going to treat the lease term as 10 years and not 15 years. So it is not a hard and fast rules, guys, what is written in the contract. What is important is, at the time when you're accounting for the lease contract, what is your best reasonable estimate of what can be the possible tenure of the contract that the lessee is more likely to reasonably exercise. So that term is a term that you've got to cover. And whatever is the money that you're receiving, you will spread it evenly throughout the term. So if you get the first 6 months free, you're going to say, okay, it's a 3-year contract, first 6 months free. So whatever is the amount that you're going to get in the next 2.5 years, you take the full amount and you divide it by complete 3 years tenure. So it's not 36 months. It's not 30 months. You're going to divide it by full 36 months. Is this clear? Anybody, any questions? Take the full consideration divided by the full term of the contract, whatever you are expecting the contract to last for. So if first 6 months are free out of a 36 months contract, take the full 30 months, whatever is a dollar value, and you divide it by 36. So evenly spread it throughout the tenure of the contract. Okay, so that's one thing. Wherever you see it in the question, understand full amount divided by the full expected term. Now, what are lease payments? Now, there can be various situations where the lease payments will differ. Obviously, it is a rental payment. So if Tesla leases out a car, that car has a fixed monthly rental, and that monthly rental will become your lease rental. That's number one. Second is this purchase option. The second example I gave you about Anita taking a condo. If it says that after 3 years, she can extend the contract. Or let's say if the contract between Tesla and Anirban would have been such, which said that for 72 months, you pay me X number of dollars every month, and thereafter, you can purchase the car for me at a predetermined price today. So that's called the bargain purchase option. Now, one thing I want you to understand here, guys, whenever in a question, they tell you bargain purchase option, typically it does not mean that the lessee will not exercise the option. Whenever there is a bargain purchase option, if no other data is given, you will assume that the lessee will have to exercise that option. Basically, it is a favor to the lessor. It is more favorable for the lessor. So whenever in a question, unless and until they write you specifically that a bargain purchase option will not be exercised, or the lessee is not reasonably likely to exercise the option, unless and until that caveat is given, the moment you see exercise price for purchase option, that means at the end of the lease term, the lessee can pay X amount of dollars and buy back that property. You will always assume that it will be exercised. That means increase the lease term by the entire value of this. So we'll see in a question, we'll talk about this and we will see how this will work out practically. As I told you, in case of this, guys, this is something that I'm just giving you an idea here, so that when you start using it in the questions, you'll be in a better state. But this is like a gray area. Every question might have a different situation. So understand whatever you get, let the incentive spread out throughout the tenure of the lease. If there is a purchase option and nothing is given to you, you will always assume that the lessee is going to exercise that option. If there is a penalty for terminating the lease, let's say you will have to give X number of dollars every month if you are terminating the lease X number of months earlier. So I tell you it's a 3 years contract, but if you terminate it early, then you have to give me 2 months notice. If that notice is not given, this is the penalty. If that notice is given, then also this is the penalty. So if you are likely to terminate the lease beforehand, then you need to feature in that penalty also as a lease payment. So basically, lease payment is a total value of the consideration that will move from the lessee to the lessor. Okay. Now there is one term that will be used often, which is called guaranteed residual value. In my example, after a 72 months contract, if Tesla says that Anirban will have to pay, let's say 5 lakhs, that is the guaranteed residual value of the property, then that becomes my guaranteed residual value. Now, one very important thing that I want you to understand here is this guarantee can be given either by the lessee or by any other third party. And this is what is the biggest delta between something called a direct financing lease, as I told you, which is not tested lot, or a sales lease. So typically it means that even when Tesla is getting into a contract with you, you come up and say, okay, this is a dollar value that will be of the Tesla car that will go back to you. If Anirban says this, then it becomes a guaranteed residual value by the lessee. If apart from Anirban, let's say there was a finance agreement in which the entire asset was purchased through a bank, and let's say the bank value or guarantees this minimum value to Tesla on behalf of Anirban, then it's a third-party guarantee, and that is what is going to be the biggest delta between a sale and a finance type lease. We are going to get to this when we discussing the direct financing type and the sale type lease. So right now, just understand it is the minimum value of the leased asset, in my example, the Tesla car, after 6 years. But it is predetermined right now when the car is given on rent to Anirban from the lessor, which is Tesla company. Okay. Then we have something called a discount rate. We'll see how Tesla uses something called the incremental borrowing rate. But there are 2 rates typically, which is there in every lease. So in your case, understand, guys, that they're going to give you a fraction of the questions where many of these rates will be given to you. You will not be required to calculate these rates. But if they tell you what rate you have to use for discounting, we're going to use a rate which is termed as rate implicit in the lease. What is that rate implicit in the lease? It is that rate at which, when you have you done the concept of IRR, a rate which equates the potential outflows PV into the PV of the inflows. The same concept you're going to apply here. The fair value of the leased asset, if it equals the lease payments, whatever you're going to get, and the guaranteed value and the unguaranteed value of all the PVs. So all the inflows minus the outflows, whatever is the rate that equates the two becomes the rate implicit in the lease. Now, in most of your questions, you will not be required to calculate the risk. This will be given to you. So understand, if a rate is given in the lease, you will use that rate. If that is not given, you're going to use something called lessee's incremental borrowing rate. We're going to see how this pans out. Okay. Till now, anybody, any questions? Yeah, these are just the building blocks. We're going to use this when we are going to work the questions together. Okay, so just understand that these terms will be used. What's a lease term? What is a lease payment? So lease payment is a P of everything that you're going to get. The lessor is going to get from the lessee. Discount rate is either the rate which is implicit in the lease, a rate at which the PV of the outflows becomes equal to the PV of the inflows, or if it is not given to you, you will take the lessees. Now, what do you mean by incremental borrowing rate? So, in case if I had to finance, if Anirban had to finance this car by taking a loan, what would be the rate that he would pay for that loan? That becomes his incremental borrowing rate for taking that Tesla car.